In this video, I'll explain to you what the pass-through entity is and how you can save thousands in taxes every year if you use it right. So what's the definition of a pass-through entity? Well, it's an entity where all of its profits and losses pass through to its owners. It's also known as the flow-through entity, and it's a very important part of partnership taxation in the US. And how is this pass-through entity taxed? Well, all the taxes are paid at the individual level. And this is because, as I mentioned, all the business's profits and losses pass through onto the business owner's individual tax returns. So can be taxed as pass-through entities? Well, they're entities that are taxed as S-corps, partnerships, and disregarded entities. And these entities include corporations, LLCs, and limited partnerships. And what's an example of an entity that's not a pass-through entity? Well, this is a C-corp, because C-corps face the double taxation. And this is where the entity faces two levels of taxation. The first one is at the entity level itself, and the second one is at the individual level. And this is where the company first pays taxes on the entity level. And then if any dividends are paid out to the company's shareholders, then those dividends are taxed a second time at the individual level. And because of this, the business's profits and losses do not flow through onto the business owner's tax returns. And here's an example of how the pass-through entity can benefit you during tax season. So let's say that you have a corporation, and in the first example, let's say that that corporation's taxed as a C-corp. And to make things easy, let's say that that corporation has one shareholder and the corporation generates $1 million in profits in the taxable year. Well, if it's taxed as a C-corp, that C-corp is going to need to pay the 21% corporate tax at the entity level. And with this tax, the corporation pays $210,000. Now this leaves us with $790,000. And let's assume that the rest of it is paid out as a dividend to the shareholder. Well, in this case, the shareholder pays a 37% tax on that $790,000. So in this case, the shareholder is paying $292,300 at the individual level. And the total tax here is just above $502,000, or more than 50% of the corporation's revenue. Now let's say that you have the same corporation, except this time it's taxed as an S-corp. Well, in this case, the $1 million in profits pass through onto the shareholder's individual tax return. And here, the shareholder only pays one tax at the individual level. And in this case, the shareholder would be paying 37%. And as such, they would have to pay $370,000 in taxes. So with that S-corp, the shareholder saved $130,000 in taxes from being taxed as an S-corp. So why should you have your business taxed as a pass-through entity? Well, it's pretty obvious, because you can avoid facing the double taxation that C-corps face. Now, in most cases, this can come in really handy, but you're going to want to double check with your CPA to see if you should be taxed as a pass-through entity. I also have a new book called The 5 Tricks to Teach Your Kids About Money. You can download the book for free by clicking the link in the description below. If you're looking to start a business, you can schedule a free 15-minute consultation with us at Corporate Direct by also clicking the link in the description below. And as always, please make sure to like, subscribe, leave a comment, and turn on that notification bell. And I should warn you, the contents of this video are not legal advice and no attorney-client relationship has been formed.